And I like to talk to my clients about bringing some diversification into the types of accounts that they have because, there's a lot of money in qualified accounts. And when I'm talking to them, I like to replace tax deferred with tax postponed. I had a client once that was genuinely shocked when he turned 70 and a half that he had to take money out of his IRA account.
Oh,
He
jeez.
was furious about it.
That's funny.
But, so when I talk to people now, I say, let's just pretend that you wanted to borrow some money to put a pool in your backyard. And you were asking me what the best way to do that was. And I said, well, you know what? I've got 50 grand laying around. I'm not doing anything with it. I'm not going to need it for a while. How about I just cut you a check? You good with that? Probably have some questions, right? When do I have to pay it back? How much are you going to charge me to use it? But we don't ask any kind of those questions whenever we're putting money into qualified accounts. We don't think about that.
Right.
You want to know those things normally if you're making a loan when you got to pay it back and how much it's going to cost you to do it. But I'll just let you know later down the road when I get ready to use it how much you owe me back. Well, we wouldn't do a foolish thing like that. We wouldn't make a loan on those terms. And so, I think we really have to start thinking hard about how much money we're diverting into those qualified accounts because they can and they will change over time. They did it this year. They
Yeah.
changed
And
the age and
and it's what I talk about and all the time that the vast majority of the wealth in America is in qualified money of some sort, some kind of IRA, retirement plan, 401k, 403b, what SEP, simple,
Mhm.
whatever you use are in qualified plans. And they changed the rules even on a Roth this year.
Mhm.
So think about the vast majority of the wealth in America. Last time I looked, it was $19 trillion, but I don't know what it is now. It's probably well over that. But it's an enormous amount of money. And you know how the government works. They think if they regulate it, they own it, they control it, they can do whatever they want. Proof of that is what happened this year. They didn't ask, did anybody get a survey from the government? Hey, would you mind if we do this? Or we mind if we do that? Do you think it's okay? Would you, we didn't, all of a sudden, when we woke up January 1st, the rules were different. Now, it doesn't matter that some of those rules were beneficial to us. That's true. The point is they were able to change the rules. Some of those rules weren't
Yeah.
beneficiary, like the leaving of our 401k to our heirs, or our Roth IRA to our heirs. So I think that we've got to keep that in mind. It's so true, and I like what you say. You're telling people that it's taxes postponed, and
Mhm.
so they can, that kind of sticks with you a little bit more than
Yeah.
than deferred.
Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.